Hi everybody. Thanks for coming today. And my name is Matt Waters. I'm a CPA. I thought when I took the CPA exam that I would learn the 4 bright lines test, for lease accounting. I thought it was going to be an easy exam question because it's so rules driven, right? And I figured I'd learn those rules and then just forget them. And little did I know I'd end up spending most of my career working on lease accounting. I started at American Tower back in '05, and I was moving to Atlanta to work there, and kind of in between, commuting a little bit on the weekends. And my VP of finance called me up on Sunday afternoon. This before Blackberries, or iPhones. He calls me at home, basically, hey, this is your boss. Don't come to Atlanta tomorrow. Fly to Boston, and we're going to get you to take a look at some leases. So I get there, and there's about a 3-foot stack of lease documents on a desk, in this stark office, with no windows. And they said, okay, read these leases. Tell us if it's capital or operating. And so that was my first experience with true work of lease accounting. And then, as Kelly mentioned, it's been ongoing since. Spent 6 years at Home Depot. While I was at Home Depot, the FASB and the ISB started talking about the convergence project, and that attracted a lot of attention. I get calls from the controller's office, who is hearing from the audit committee. What is the impact going to be on Home Depot's balance sheet? And of course it was huge, with all the stores and you name it, forklifts, even airplanes. And so we had to quickly come up with some estimates of the impact. And it was during that time I got introduced to CoStar, and Mark and Ned. A lot of folks here have been around for a long time. We started talking then, and then eventually, when the transition finally became obvious that it's going to go live and bring us to the point where we are now. I started working with CoStar. I've been here for over 2 years now. But one thing that people ask about, and really, I guess, as they're getting towards the end of their compliance process and getting ready to flip into full compliance with ASC 842, IRFS 16, is what are our auditors going to be looking for? At in the first quarter of next year, and then ongoing, and so we thought it would be beneficial to just talk through what we're hearing in the industry, and really, I like to say in all cases when we're talking about what auditors are looking for, we're talking about setting internal accounting policy. CoStar does not set your policy. Of course, CoStar is not going to be auditing your company, but at least we have the benefit of talking with hundreds of clients and their auditors as we go through this process, and I think we can shed some light on at least some things to look for. Now, I already mentioned I'm a CPA, and like pretty much all CPAs, I love talking in front of a camera, right? I mean, it's just the core competency for our profession. But I did, Kelly Clark can tell you, we attended a conference one time, and we're standing in the common area, and this gentleman walks up and he said, "You're Matt Waters." And I said, "Yes, I am. Hi." And I didn't recognize him. And he said, "You're the YouTube sensation." And he was talking about my CoStar YouTube video where I talk about lease accounting. So, of all the things to be famous for, right? The first item that I think we should talk about as far as what auditors are going to be looking for is a complete collection of lease obligations, okay? So this is a huge issue for really all companies right now. I mean, as we've been, since the late 1970s, we've been operating under what was called FAS 13 and then ASC 840, which required most leases, operating leases, to be straight-lined. And the straight-line calculation could be done in Excel fairly easily. It's It's just add up all the rents over the term, divide by the number of months. And so, as a result of that, many leases calculations were never even performed on them because they were inherently straight-lined, like equipment leases. You know, a lot of times, copiers and fax machines, things like that, rents did not escalate anyway. You know, really, a lot of times it was just real estate and really complex, you know, high-dollar equipment leases like airplanes that would get scrutinized and sometimes qualified for capital lease treatment and added to the balance sheet. But by and large, the majority, you know, from a numbers standpoint, number of leases standpoint, most leases were operating, and most equipment leases were not even collected into a central repository. They were expensed as incurred, and that was really perfectly fine because most of them did not need straight line. Now, companies have been given the directive to go out and find all of those operating leases, you know, the equipment leases that are scattered across the organization, you know, in silos a lot of times. Business, you know, department heads and even individual store managers, you know, and unit managers have the authority to execute a lease to take care of the needs of their division or store. And there was no corporate oversight or initiative to collect those. So people are pulling things out of desk, you know, drawers and file cabinets and you name it. So really, as auditors dive in, I would expect to see some verification that all leases have been accounted for. And they'll probably go about that in the same method that a lot of our clients are using now by sending out surveys into the field and then getting a response back. You know, do you have any contracts that convey the right to use a piece of equipment, you know, that you provide consideration for? You know, things like that will probably go out from auditors, and that really is a best practice we're seeing now. That's the same kind of communications that should be coming out of the controller's office or the finance team now to collect everything. Here is a slide that just talks about some of the potential sources of lease data, and it's certainly not an all-inclusive list, but I find that, you know, just putting up a list sometimes can help spark somebody's memory of, oh yeah, we may have something like that. The legacy real estate system, I mentioned, you know, real estate is the one exception. A lot of companies already had data around real estate leases. SharePoint sites, sometimes the procurement team has used SharePoint or some other type of repository to track contracts. That can be useful. I won't just drain every one of these, but you see file cabinets and desks there. Lessor software, I think, is a great source. You know, the companies that provide fleet vehicles, the one I hear often is Wheels. These vendors that even forklifts for you guys who have materials handling. A lot of your leases in those spaces come from one vendor, and many times you can get that vendor. They're, of course, by now quite familiar with the new lease accounting standards if they're in that business. They can probably send you a file every month or give us here at CoStar some way to communicate back and forth with their system. It can save you a lot of time. And then, you know, if all else fails, and I recommend this as a kind of a maybe even an initial step, and then come back in the end as a last step, a good old-fashioned P&L analysis. You know, see which expense accounts could possibly contain something that could be considered a lease, and then kind of work backwards from there. You know, if you see a huge expense every month for copy machines or you name it, you can probably trace it from the P&L even. And that's going to be a kind of I think an obvious place that auditors will perform some analytics too. as they're looking to make sure your portfolio is complete. Now, one other area I think is worth mentioning is the lease footnote work papers. So, if you file a 10K, this is something that's kind of near and dear to my heart. I worked on these for many years. You have the existing requirements under 840 of the 5 years and thereafter lease obligation, and really the items that fed into that footnote are the same items that technically you need to report under ASC 842. So that's the perfect place to start, I think. Okay, embedded leases. This is a term that we really had never given any attention to before this new guidance came out. But embedded leases, this just means that you have some type of agreement. Usually it's a service contract, but there is equipment involved in delivering the service. I think a classic example is IT related. If you have some type of IT hosting agreement or just any kind of IT service that requires dedicated equipment like a server, you may have an embedded lease there. And then even a kind of a simpler example that I think makes a lot of sense is alarm. Many of us have alarm systems in our house. Of course, almost every business will have some type of alarm system, and there's always equipment involved. But a lot of times you don't pay for the equipment up front. You sign a contract, you pay a certain amount a month, and they come and install a bunch of sensors and keypads and things. So, that's a simple example. It may not be material for your company, but it kind of gives you an idea of how broad this embedded lease conversation can reach. I think that's a major risk because, we've all worked with auditors before. They'll come in, they'll start asking questions, they'll send surveys out, they'll want to know, they'll ask it a little bit differently than maybe you did on your survey. And I think this is a huge area where they may be able to find something. One other, I guess, embedded or hidden type of lease, it may come along with a lease that you've already identified. An example from my personal experience is forklifts. At Home Depot, we had thousands and thousands of forklifts. And as we prepared to transition to new lease accounting, we discovered that the forklifts, the leases for the forklifts did not include the batteries for the forklifts. The batteries were included on a separate lease. And one thing we discovered was that we had leased, or at least we were paying for, thousands of extra batteries. And it turns out that maybe they had gone bad and been replaced, but the vendor had never taken them off of our bill, right? So, it's kind of a hidden lease, something that could have been overlooked. Also something that because we went through this process and organized our leases, we saved a bunch of money. Okay, so again, another list. Certainly not going to read everything on this page, but you can see just so many different types of equipment that could be leased, and it's really any asset, but to the extent that these items are included in contracts for services, you may have a lease that you need to put on your balance sheet. Here, people, we travel around the country now talking with various clients, and the brainstorming sessions are interesting sometimes. People start going down the path of, well, wow, what about our dumpsters? We pay a service to come by and collect the trash, and included is this dumpster. Is that a lease? What about the folks who come in and clean the building? They have equipment. They have floor cleaning machines. Some of these floor cleaning machines are you actually ride on them. It's like a Zamboni at a hockey game, right? These are expensive pieces of equipment. Maybe the janitorial company owns it, but it's always at your facility. Might be an embedded lease. So just things like that. It's it's key just to think through so you know, and in so many of these areas, auditors, in most cases they're reasonable, and in most cases they'll also, you can talk with them ahead of time and say, hey, we're setting a policy about this, for embedded leases, here's our policy, and I'd say, in my experience, a lot of times that works out so much better if you identify a potential question or an issue. You go ahead and set a policy of how you're going to account for it, and then you just show that to them before they come in for the audit, and get their blessing ahead of time. I think it saves a lot of time and effort, and many times money too. Okay, the next one, proper separation of lease and non-lease components. So this is an example of something that that again was really required all along, but just because of the nature of the way the standards change, it really didn't have a huge impact before, because before most leases were on the P&L only. Most were straight lined. Some contain non-lease components, but most non-lease components are inherently straight lined. So it really didn't matter if you missed some of these. As far as it was just geography on the P&L. Now, if you include non-lease components, you've grossed up your balance sheet, and you can include non-lease components. It's a practical expedient. So to the extent that you have leases that have everything lumped into one payment, let's say you're leasing a building and you have CAM charges, it's all included. Or if you're leasing equipment, you have maybe some maintenance charges that are included in the lease payment. If it's convenient for you, you can take that practical expedient, lump everything together, call it a lease component, but then it becomes part of your right of use asset and lease liability, grosses up your balance sheet. So some companies are more sensitive to having a higher liability on their books than others. Some companies are more happy about the opportunity to save time in splitting these things out. So it really is a company by company decision on this. But once you set that policy and make the decision of which class of asset you're going to apply the practical expedient to and which class you're not, then you have to apply it consistently. And I would really expect auditors to be looking at this closely to make sure that you're following the guidelines on this. One other, just a quick point on that, since we have so many accountants in the room, one item that some companies don't think about immediately with this, if you do use the practical expedient, lump everything together, you get a higher lease liability, you get a higher right of use asset. Then that right of use asset is more likely to be subject to impairment because you've put a higher asset on your books. So just something to consider there. Of course, inaccurate key assumptions. There are just so many assumptions that go into new lease accounting, and this is something even in the project planning phase, I think initially was overlooked. The number of accounting policies and assumptions that you need to make can be kind of daunting. We mentioned we mentioned practical expedience before, but there's another very key assumption around reasonably certain. If you're reasonably certain to exercise an option, you're supposed to include it when you calculate right of use asset, lease liability. If you have to make a policy or assumptions about your incremental borrowing rate in most cases, because you, as a lessee, you don't know. In most cases, you have no idea what the lessor's rate of return is. They're not going to tell you that. So you use your incremental borrowing rate. You have to set policy, make assumptions about that. Estimates for CPI and other index-related increases. That's a huge policy that you need to set. And there's been some recent activity from the SEC on this. I spoke with one of one of my peers in the industry the other day, and his company actually worked with several other companies and contacted the SEC about CPI escalations and had a letter response issued back to them to clarify how to apply CPI. And specifically, I won't get into huge detail on this, but specifically they were asking, well, do we use the CPI estimate from the inception of the lease? Because that's a literal interpretation of the text of AC 842. Or do we use the CPI that's in effect right now on 1/1/19, for example, as we transition? Now, I think common sense says you use the one at transition, because you know that right now as you're going in, but it wasn't super apparent or obvious in reading the standard. So they did get that clarified, and I'd be happy to share it with you if you like. Okay, now here, of course, at CoStar, this one is near and dear to us, the software and key data configuration issue. So if you have, of course, you're all here at the CoStar customer conference, so you're all fine on this. I'll just skip it, right? No, I mean, it's a huge issue in the industry. I mean, there are many software companies have really popped up overnight. I actually just got a news alert yesterday that there's a brand new lease accounting software on the market, and it's literally, it was released yesterday. And I'm thinking, wow, I mean, we're a few months away. This is not something that you would want to go with something that hasn't been around for a while. But of course, CoStar has been around for many years, and we've vetted the system quite carefully. It's been reviewed by all the big four at this point. Hundreds of customers, dozens of audit firms have been through the system. So again, as Andy mentioned this morning, we know we're dealing with a smart group of people in this room. Early adopters. Now, we've had very few early adopters. I mean, the number when the standards first came out, we had a bunch of folks saying, "Oh yeah, we're gonna get our ducks in a row. We're gonna start a year early." Honestly, you can almost count on one hand, I think, industry-wide, not just CoStar customers, but all across the U.S. There has just been very few early adopters. Now we have taken clues from a few of them, and one thing that we saw is one, even those guys, it took longer than expected, and in our next session, Mark and I are going to talk about some strategies around that, how to shave some time off of your project. Another thing we've learned is as the early adopters came online, of course they've already been through some reporting cycles. They've already released some earnings and produced some 10Q reports, and so we have gotten the benefit of those to be able to tailor our reports that come out of CoStar, our standard reports, the disclosure report, for example, tailor those to the look and feel of what's already been successful in the market. Now, we have resources available on CoStarManager.com. I know you're all at various stages of the process, and sometimes even towards the end of a process, you may want to go back and just review the recommended steps, make sure nothing's been left out. Planning for lease accounting compliance is a white paper, 12-step guide. It covers some of the points that I talked about today and from a slightly different angle, but also includes more of the lists. The few examples were here today, but a list of things to consider, departments to bring into your group of stakeholders around your organization, and then just various other white papers and blog posts you can find on the website.